Peter Lynch, a renowned investor and author of well-known book One Upon Wall Street, once remarked, investors have lost significantly more money trying to predict market corrections than by experiencing the correction themselves. This astute observation highlights a frequent error made by many investors. In this video, let us look at the hidden dangers of anticipating market correction in detail. Welcome to holisticinvestment.in. Why do we constantly fear market corrections or crashes? Imagine you are at a cocktail party, chatting with fellow investors. When someone mentions a news report claiming the market is overbought and correction is imminent, a wave of anxiety ripples through the room. The fear of seeing hard-earned investment decline is a natural human emotion, and it is easy to get caught up in the sentiment. This fear often leads people to anticipate market movements, turning them into speculators rather than true investors. Wouldn't it be ideal to buy just before the market rises and sell just before it falls? While this strategy could theoretically make you rich quickly, but in reality it is a big question mark. Haven't countless successful investors tried this strategy? While it may seem tempting, even legendary investors like Warren Buffett have acknowledged the difficulty of consistently timing the market. Buffett famously said, "The stock market is designed to transfer money from the active to the patient. Trying to time the market frequently is more likely to result in losses than gains." Next, the unpredictability of market movements. The difficulty in timing the market is straightforward. The market can fall much more than anticipated and rise beyond expectations, often surprising investors on both sides. Take a recent example. The market reached 80,000 levels and your portfolio surged by 10%. Your initial 10,000 investment quickly grew to rupees 11,000. Business channels are buzzing, claiming the market is overbought and predicting a correction. Wouldn't it be great to sell your mutual funds now? Lock in the 10% profit and buy back when the market drops. The illusion of predictable corrections. You decide to sell, feeling satisfied when the market shows signs of falling with a 2 to 3% drop. You wait for it to fall a bit more, but then the market rebounds and rises even faster, shooting up another 10%. How successful is market timing? As Peter Lynch said, in this business, if you are good, you are right 6 times out of 10. You are never going to be right 9 times out of 10. The missed opportunity. What are the dangers of trying to time the market? Imagine if you hadn't sold your investments, your initial 10,000 investment would have now be 12,000. Instead, you have cash sitting idle in your savings account. Now, new questions start to arise. What if the market doesn't fall? What if it continues to rise? Have you missed the opportunity? This scenario illustrates the inherent challenge of trying to predict market movements and underscores why Peter Lynch's advice remains so relevant. Common reactions to market fluctuations. In such circumstances, most people end up taking one of two paths. They either buy back during the next small correction, often at a higher price than they initially sold, or they find a way to spend the money on something else. The trap of anticipated corrections. Remember this, when a correction or crash is anticipated, it usually doesn't happen. Anticipated corrections tend to get delayed, and true crashes occur either during periods of extreme market optimism or due to unforeseen global events such as COVID-19 pandemic. The pitfall of selling high quality portfolios. I have known investors who built portfolio of high quality companies only to see their stocks in anticipation of a market correction and then struggle to rebuild their portfolio to their former glory. John Bogle, the founder of Vanguard, wisely said, "Time is your friend, impulse is your enemy." This underscores the importance of staying invested and not letting fear dictate the investment decisions. Lessons from the 2020 market crash. During the 2020 market crash, those who tried to sell and buy back at lower prices often found themselves unable to re-enter the market. The fear at the bottom was overwhelming. You only recognize a bottom after it has passed. But during the decline, it always feels like there is more room to fall. Next, the swift upward journey. When the market eventually began its upward journey, the rise was swift. Many investors missed the opportunity to buy because the previous day's prices seemed much cheaper and they kept waiting for those prices to return. Here is the final segment. Key takeaway for long-term investors. If you are a long-term investor in a country with immense growth potential like India, stick to your equity investments. If the market experiences a significant drop, consider buying more. Learn to manage your risk. Maintain an emergency fund and sell only when you genuinely need keep the money. As Benjamin Graham, the father of value investing, said, the individual investor should act consistently as an investor and not as a speculator. By following these principles, you can avoid the pitfalls of trying to time the market and focus on building a strong long-term investment portfolio. A detailed blog post on this topic is available on our website. Check the link in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.